Hi, I'm Pete Riley, your tax matters partner, and today we're going to be talking about Code Section 183. The title of the course is Actually and Honestly for Profit. Um, I've been cutting down the time. I've cut down the time of this presentation, uh, but I didn't do a good job of pruning the slides. So we may not fully address all the slides, may skip over some of them uh, pretty pretty lightly, um, but that's fine. Um, there's some information about how to contact me. I have a pretty elaborate spreadsheet of Section 183 decisions. I'm trying to get them all and to analyze how the various factors were decided and how that relates to the outcome of the decision, um, along with some other information on the cases. It's a spreadsheet. It's now at over 700, and I'm still not done. I don't know if I'll be able to find them all, but I will try and get as many as I can, and it's a pretty good sample. I think it's pretty complete on the on the on the more recent cases. Uh, at any rate, let's get going. The other thing I have to do is plug my book, Riley's Laws of Tax Planning and Life, which came out not that long ago. It was published by Think Outside the Tax Box, and one of the things about the laws of tax planning is the very last one, which I added, is the 18th law of tax planning: honest objective trumps reasonable expectation, which is the key to my position on the hobby loss. A lot of my laws of tax planning are about things that go wrong. Like one of them is read the instructions, uh, or but this one tends to be a little more optimistic. Uh, I've learned a good bit from experience over 41 years of being a CPA, and then longer than that because the experience requirement. Uh, but the thing about learning from experience is expense. Those lessons are expensive. It's better to learn from other people's experience, and much of that I got from reading tax court decisions and the appellate decisions. Tax court is probably the main thing, because I can read those decisions. Um, Partially, I'm thinking, well, maybe I'd use that one on an audit. I'd show that to the agent as to explain why I'm working, but it also lets me reflect on how did these people get in this situation, and you know what were the mistakes and how you can do better. And the other thing is the people watching the people who win, um, and that's what kind of changed my attitude. Studying those cases is what changed my attitude towards hobby loss. I used to be very negative on um, somebody doing something or other and throwing that on their Schedule C. I used to always I'd feel very negatively about it. Um, I still have issues with it, but I think there's more positive, and I think we practitioners should possibly take a more positive attitude to our clients' aspirations to I don't know, uh, start a store that sells Spanish American war memorabilia or whatever thing. It might sound crazy to us, but maybe it can be a real business. And that's mainly what this is about. Will the perspective is argument for a more aggressive approach than many practitioners have. I mean, there's some people with. If you go on TikTok, it's a different story. But so at any rate, the stakes are high. Are high sometimes in these cases. The IRS came out with an audit technique guide for activities not engaged in for profit, and in 2021, which really isn't that long ago as these things go. And one of the things they say is if there's a 183 issue, you should make that your primary position. Frequently, 183 will interact with 469, the passive activity loss rules. And the IRS in this makes the position is 183 will create a permanent adjustment, a permanent loss of deductions. 469 is a timing thing. You'll get those deductions eventually unless you die with them. And there's other things that people get tripped up on when they're trying to get a negative number in their adjusted gross income. The at-risk rules being it. But I actually have this article I wrote. It's about the hoops that you have to jump through in order to get a negative number into your adjusted gross income. And 183 is the first hoop. You don't get any further if you don't get past 183. After that, then the loss has to be allocable to you if it's an S corp or a partnership. Then you need basis. You need to be at risk, and there's the passive activity loss rules. There's another one if you've got big dollars. But we're focusing on 183, which is the first hoop that you have to jump through in order to have a negative number that you get to plunk into your AGI. And that's one of the more effective ways of reducing the tax bill. The first thing to mention is, and this is a little pedantic, is that we talk about the hobby loss rule. That's not in the code. It's not hobby losses. It's activities not engaged in for profit. However, when you read the committee reports and a lot of the case law, often they are talking about hobbies, but there were 183 was used a lot against tax shelters, and people weren't enjoying buying oil deals or master recordings of records or movies. All sorts of other things. There are a lot of shelters that predate the at-risk rules, and they go after them based on 183. It's not been used that much against shelters in recent years, although it has come up a few times. So it's something to keep in mind. Somebody might be doing something for some reason, and not that and it doesn't seem at all hobby-like. Um, but it can fall into 183. The other thing that's odd about 183 is it's actually an allowance section. It allows a deduction, um, but it also states that it's the only deduction with respect if the activity falls under 183, not engaged for profit, the deduction computed under 183 is the only deduction. But currently, it's you don't even get that. I'm not going to go into the complications of the deduction allowable on 183 because right now it's not allowed thanks to the Tax Cuts and Jobs Act. Um, uh, but essentially, if you're engaging in an activity that's determined to not be for profit, you first get to take deductions that would otherwise be deductible. Um, uh, for example, taxes, which that's the only thing I can think of. It used to be taxes and interest, but that's prior to the Tax Reform Act of 1986, when all interest was deductible pretty much. And so there's a rule about that, and then you get to take this deduction, itemized deduction, subject to the 2% floor, to the extent that you have gross income. So now though, and going into 2025, you don't even get that, and of course we don't know what's going to happen after 2025. But this could make the stakes even higher. There are sometimes it's not quite often people engage in a 183 activity and there's hardly any revenue at all. But there'll be some activities where the revenue can be quite substantial, even though the losses are quite substantial. So it'll end up being like if you're selling cannabis and you don't get the 162 deductions, which complicates things. At any rate, so that's an important thing about the stakes. So where does this all start? And I like to, say it starts with sex, drugs, rock and roll, and the moon. The Tax Reform Act of 1969. Actually, as I've studied the case law a little more, you realize that it starts well before that. There was always a doctrine that 162 deduction, in order for a 162 deduction to be allowed, you need to have an actual business. You need to have a profit-oriented business in order to take a 162 deduction. So there's a lot of case law that could be potentially relevant that goes back to the period before the Tax Reform Act of 1969, where 183 was enacted as an allowance deduction, saying, it's okay, well, we'll give you an itemized deduction to the extent that you have income. 183 replaced a code section 270, which had limited to 50,000 per year the amount of losses on a trade or business, but that limitation only applied where the losses from the business exceeded 50,000 a year for at least 5 years. So people would screw around and manage to show a profit every 5th year. oddly enough, I started in the business in 1979, and people still remembered this rule and still thought it was applicable. I mean, somehow, but and it still it still reverberates in people's memory. But the other thing you notice there, when it's $50,000 a year. I have a little shortcut thing for when they say today's dollars. I've created this little graph to come up with a multiplier for different points in time. In 1969, you multiply by about 8 to get what it would be now. Very approximate, but so they're talking about 400 grand is when this rule would when the 270 rule would kick in. But 183 creates this thing. Hey, you got income? Yeah, we'll give you an itemized deduction. But that's it. So it's much more wide ranging because it kind of takes in every way. The other thing that was indicated in the committee reports that was that they would take an objective rather than a subject approach, and most importantly, and this is one of the most important concepts, one of the keys, if you're planning with a taxpayer or more representing them at an audit, is that a reasonable expectation of profit is not required, okay? It's not a matter of an expectation of profit. It's the objective of making a profit. So someone could know that their chances of making a profit are quite low. The common example that's used is wildcat oil drilling. And I was talking to a guy recently, and it's like, apparently that might not be a thing anymore because there's science has advanced and not science has taken a significant amount of the guesswork out of oil drilling. But the example would be somebody would spend a lot of money because they thought that there's a good chance there'd be oil, and they drill down and there isn't any oil. And if you decided you were going to do that a lot, your expectation might be, maybe I'm never going to make any money, but if I do hit, it's going to be big. And that's okay. It's having that objective, and it might be a long, far-seeing objective. So that's an important, very important concept to remember in planning in this area. So now, when you read random articles about Section 183, there usually be a pretty significant discussion of 183D, which is the presumption. And the presumption there is if you have profits in 3 out of 5 years or 2 out of 7 if the activity involves horses, okay? And when the Tax Reform Act in 1969 passed, it was a senator from Kentucky who got that 2 out of 7 adjustment thrown in there because horses are special. Of all the various crazy things you can do, fooling around with horses, that's something where you need more time. I'm almost tempted to not even discuss this rule because it does not come up. It comes up hardly at all in the case law. And it is also why often greatly misunderstood. I've seen it. I was talking to this guy. He had this dinky little business. He actually kind of related, and I'm talking to him, and he says, "Oh yeah, well, I've been losing money on the business, and I lost money for 3 years, and then the fourth year came along, and I lost money, and my accountant told me I couldn't take the deductions anymore." And and I'm saying, "Oh." I said, well, how much are you losing? And he says, well, a couple $100 a year. And I said, yeah, whatever. I don't, I didn't want to get involved, and there wasn't any huge harm being done, but that is just wrong. Okay, there's a presumption in favor of the taxpayer, um, that if if you meet that rule, either the 3 out of the 5 or the 2 out of 7, you have this presumption in your favor. It never seems to come up in the case law. It'll be discussed briefly, and it's like, well, it doesn't really matter because they're going to go on, and because it gives you like this little edge. It might have come up once or twice, but it's not significant. But most importantly, and I think sometimes there may be even agents that don't understand this, because in the audit technique guide in 2021, there's this statement. I don't know if they put it in bold print, but I'm putting it in. Examiners cannot use 183D as the reason for disallowing losses under Section 183, even when the taxpayer fails to meet the presumption. It's not something the IRS can use. It doesn't give that. The fact that there's been 5 years of losses doesn't give them an edge when you come to court. Where if you've made a profit in 3 out of 5 years, there is a presumption in your favor. But of course, if you made a profit in 3 out of 5 years, they're not looking at you. So that's pretty much it on the presumption. There is another there's another issue. There's an election that can be made to delay determination as to whether this activity is for profit, and which extends the statute of limitation with respect to that issue. In principle, you can file this with return. If you start a business and you lose money the first year, you can attach an election to your return and say, well, I don't want this 183 thing to be considered until the right number of years has gone by. I've never even dreamed of I haven't heard of anybody who's made the election in that way. It might be that there's a reason somebody might do that. However, you can also make the election at the point of an audit, and to get more time to get to the presumption. I suspect the reason you would do that is because you'll kick the can down the road. You'll be dealing with a different agent, and you can hope that they'll lose it. There's actually procedures that the IRS has in place as to how to track this, to keep track of it, so they don't lose the case. So there must be people making the election. I've just never heard of one. But I do think it's most likely used as a technique in dealing with an audit. Again, in the case law, the presumption doesn't come up. Maybe 2-3 cases out of 700, I've noticed it being significantly discussed as being relevant. Now, this is getting dated. Okay, this is from 2016. I've been giving this course for a while, so this used to almost be like fresh, and it's getting dated. I think it might still have some relevance. I checked to see if TIGTA has said anything else since, and maybe I'll look into some more for the relevance. But TIGTA, the Treasury Inspector General for Tax Administration, which is people hate getting audited by the IRS. And some people will hate the IRS because they get audited. Well, if you work for the IRS, you hate TIGTA because TIGTA comes in and audits the IRS. Actually, the federal government, all the agencies, there's inspector generals in all of them, and they. But TIGTA at various times, its reports will get a lot of publicity because it's about the IRS, and usually, if they're writing a report because something went wrong, it ends up being something stupid, and it'll attract a lot of media attention. During the if you remember the interminable IRS scandal with Lois Lerner, which I'm starting to forget when that started. It was during the Obama during the Obama administration, and that thing just went on, and TIGTA reports would be a significant part of it. Well, they did a report that didn't get a tremendous amount of publicity on hobby losses, and what they did is saying, well, geez, is the IRS doing enough audits of hobby losses? And of course, they come back with a report and says, no, you're not. And in designing their study, what they said is well, we're going to look, these are the returns we're going to look at and see what action was taken. And what we're going to look for is a $20,000 loss, less than $20,000 in gross income, 4 years of losses, and other income of $100,000, which, even in 2016, that's not tremendous money. So they're looking at the little people, and you actually the case law, there's not a tremendous amount of case law in the recent few years, but you kind of definitely see this. You might see these criteria at work, and in the tax court decisions, they'll actually say, well, this guy was making $120,000, so he could afford to lose all this money on this silly thing that he was doing. That's one of the factors. We'll get to that. At any rate, I think this gives you a guideline in working on returns and looking at returns, that if your client has some sort of side thing that they got going on, and 3 years have gone by, and they're starting, they've had these consistent losses with minimal gross income, you really need to be talking to them, not saying it's like, oh, 4 years are up, can't take that loss anymore, but rather to talk to them about how you can plan around this, and have an honest discussion, and just say, are you really trying to make money doing this? And if with a straight face they can say, yeah, I'm really trying to make money, well, then, what do you have to do to establish that in the event that you're audited? Uh, and that's what we're going to be talking about. Um, uh, and before we before we get to that, we look at the variety of activities where this has come up: flying, yachts, artwork, racing, agricultural, dogs, making movies, horses, lots and lots of horses. The IRS hates horses. That's really you really got to you really got to reach that conclusion sometimes from the amount of horse cases that there are under 183. The it's I've thought of it as anything that you thought when you were 10 would, or maybe 14, would be fun. It'll have there'll be a 180 there'll be a 180 there'll be 183 cases about it. The according to the audit guide, the 183 was originally primarily to limit farm losses. And if you include horse breeding as a farming activity, which it is, the farming type of things overwhelm it. I haven't done statistics on that recently, but horse, cattle, farm, and then something else is the way it will go. But boat racing, fishing, golfing, the practice of law, believe it or not, a couple of cases, travel blogging. That's a relatively recent one. Artists and entertainers. It's just tons of things like that, and sometimes things that don't seem that fun. Again, though, it was used heavily against tax shelters in the 80s, and some of the tax shelters sounded like they were a little hobbyish. Master recordings of films. There were some films with pretty well-known actors that would show up in the case law. What would happen is a film would be produced already, it's in the can, and then they'd bring in investors to distribute the film. So there's probably a little cachet to that. It's like, oh wow, I'm like a Hollywood producer now. But and these were things that would go out and bring in some money, but they would be priced very high, possibly producing an investment tax credit, even depending on when you're talking about. But there'd usually be a lot of non-recourse financing, which would create a big depreciation deduction. That was the key to a lot of tax shelters prior to the 86 Act. And they would look at it and say, "No, you're not gonna make any money in this." But there was one case. I'm sorry, I should have the name at my fingertips, but where the tax court kind of did a movie review. It's like, oh, well, this movie wasn't going to be successful because it had some big name actors, but the plot and this and this and that. And on appeal, the appellate court said, it's like, no, you're the tax court. You're not Siskel and Ebert. It's not right for you to, most or many movies don't recover their cost. So this whole artistic analysis that you did in a movie just does not belong in the tax litigation. And that instruction that is given to the tax court is something to really remember. If you're in an audit and the agent is saying, oh, this is ridiculous, this person's never going to make money doing this, that, the other thing. It's honest objective, not reasonable expectation. It's not, you second guess it, you second guessing. There was a tax court decision where people were playing the slot machines using the principles of Feng Shui, and the rule, the ruling is like, hey, this is their culture, this is their belief system, so we can't say we can't judge that they're unreasonable for doing that. And if they were real systematic, about it. Here's some bear with me. These are some of the tax shelter cases that you can look at. There's quite a few more of them.